Have you ever wondered how countries manage their economic policies in a globally connected world, facing a tricky balancing act with crucial decisions about their money? Exchange rates are intrinsically linked to the Impossible Trinity, which is a core concept in international economics, stating that a country can only simultaneously achieve two out of three desirable policy goals: a fixed exchange rate, free capital movement, and an independent monetary policy. This means that exchange rate policy is not an isolated decision, but rather a fundamental choice a country must make within this trilemma. The inherent conflict lies in the nature of these three goals. A fixed exchange rate offers stability for trade and investment, reducing currency risk. Free capital movement allows money to flow in and out of a country without restrictions, enabling efficient global allocation of funds and investment opportunities. An independent monetary policy gives a central bank the power to set interest rates and control the money supply to manage inflation, stimulate growth, or address unemployment domestically. The impossibility arises because pursuing all three creates uncontrollable pressures. For example, trying to maintain a fixed exchange rate while allowing free capital flows means domestic interest rates must align with global rates, thereby sacrificing independent monetary policy. Countries must therefore choose which two goals are most important for their specific economic situation and policy objectives. For instance, a country prioritizing trade stability and domestic economic control might opt for a fixed exchange rate and independent monetary policy, which would require imposing capital controls to prevent speculative attacks or large capital outflows. Alternatively, a nation might choose free capital movement and independent monetary policy, allowing its exchange rate to float freely and adjust to market forces. Each choice has significant implications for its economy and citizens. This concept, sometimes called the trilemma, highlights that exchange rate regimes are not just about currency valuation but are deeply embedded in a nation's broader macroeconomic strategy. It is not about choosing the best combination but the most appropriate one for a country's current economic development, financial stability, and integration with the global economy. Understanding this trade-off is key to analyzing why different countries adopt varying approaches to their currency management, impacting everything from import prices to investment flows. Ultimately, a country's decision about its exchange rate regime is a strategic one, reflecting its priorities within the Impossible Trinity. This choice dictates the tools available to its central bank and government, influencing its ability to manage domestic economic stability while engaging with the international financial system. It reveals a country's fundamental stance on economic sovereignty versus global integration, shaping its economic future.